Well, the short-term view, of course, is very difficult to assess from the fundamentals because the fundamentals have been so mixed. For example, we had a very bearish manufacturing number coming out of the Empire State, and then we had a good service number coming out. And that's really basically what's been driving the economy in the past several months and now into this, with retail sales looking good from December, which has been the service industry and the consumer. So the question really is going to be, for the short term, what is going to happen with the Fed? And right now, we think the Fed is going to sort of stay the course. The expectations aren't for interest rate cuts until later on, and I kind of go with that. So I guess really the answer for the short-term economy right now is we're stagnating. And stagnation is okay if it's not followed with inflation. It becomes an issue if inflation picks up, and that's really kind of what we're keen on watching as we go forward. So that's, that's why I pause there, because it leans into the longer term, which of course is really going to depend, I think, on what happens with inflation. So right now, people have been talking about disinflation, and of course, in many areas, that is 100% true. And what people don't understand is the definition of disinflation is when you go from high inflation and then prices start to come down. But they've only come down in certain areas, and they've not come down in others. And so if you look at a chart from the 70s, which is something that I have been sort of obsessing on as we've entered this year, if you look at 1975, we had an inflation peak, and then CPI numbers came crashing down into 1977, and then they started to pick up again. If you overlay from 2014 to the present, it actually followed where things were kind of stagnant in terms of inflation for a while, or I should say there really wasn't any inflation for a while. Then we had, of course, the post-COVID peak, and then 2022 and 1975 sort of match almost perfectly. And then you had the drop, as we've seen the drop now from 22 in CPI. And of course, we don't know what the future is, but what happened back then was by 1979, of course, inflation really started going. And why? We had geopolitical situations, we had a lot of government spending, we had the Fed easing up on interest rate policy at that point. The dollar really didn't do very much, but it certainly had fallen from the highs. So the question is history going to repeat or rhyme? And we certainly have a lot of reasons to think that that could happen, not the least of which, of course, is what's going on in the Middle East, which hasn't really affected commodity prices yet. We still, as far as I know, have a war, Russia-Ukraine. We've had government debt out of control, government spending out of control. We have weather problems. I mean, agriculturals are definitely being impacted by the cold snap here, not to mention the cold snap we've had globally. And we have global inflation. UK numbers came out showing an increase in inflation numbers there. And of course, our own CPI numbers, although not screamingly high, don't look like they're going to get to 2%. And actually seemingly bottomed in June. So if we continue that path, if any of these powder kegs ignite, or the Fed worried about a recession because some of the numbers haven't been great, layoffs are starting to increase, so we don't know what's going to happen to the labor market, may not necessarily be as strong as it's been. I mean, there's a myriad of reasons. I can go on and on from the economic standpoint, but the bottom line is anything, including cutting rates too fast, could spike inflation in the second half of the year. And if that happens, now we go from a stagnating economy with inflation to probably one of the worst words that nobody ever wants to hear, and that's stagflation. And I'm still thinking that could happen until I see real concrete evidence that it won't, and I haven't yet to see that. Well, again, my God, you want to talk about a mixed bag. We have a 50-year low in the ratio between emerging markets and the U.S. market. And when we get those kind of ratios, I get very interested because we know sort of the rubber band effect comes into play. At what point does it get so stretched that we start to see that ratio come in? And it doesn't have to be a disaster for the U.S. It could just be that the emerging markets start to pick up, and Davos is going on right now, by the way, And Lagarde said that she's starting to think about cutting some interest rates. And they've been pretty hawkish too. So they could do it before we do, which could hopefully spur some of the economy there. But they're certainly racked with their problems as well. So in terms of the emerging markets, there are certain areas we're looking at. Obviously, India has been on its own. Vietnam, which we had a lot of promise in, is kind of also just sort of floundering, not really growing, but not really falling apart like what we see in China. And that's a whole other ball of wax. So China has just been having a rough time of it. And more numbers came out today showing that the population is aging. Our sanctions have affected their imports of semiconductors, which are down 15%. So I think that China's trying to stimulate. It's going to be interesting to see if some of the European nations try to stimulate. The dollar right now is still strong against foreign currencies. We'll have to see that soften. And if those things go into place, that ratio, we could start to see come in. But it hasn't happened yet. My top pick, by the way, for 2024 coming in was AbbVie Pharmaceuticals. And it kind of hits three different areas that have also been performing well as we've started 2024. One is healthcare, and one is obviously big pharma. Biotechnology has been outperforming. And the other, believe it or not, is cannabis related, because what's happening with AbbVie is that they're actually using cannabis for some of their medical research. And so my theory was that could put pressure on the government here in the U.S. to at least, well, they're already talking about declassifying cannabis as a major crime, possible legalization. And one other thing is my vanity trade, which I came in thinking this year the consumer would go from all about we to all about me, buying things to make them feel good, whether it's beauty products, skin, makeup. And AbbVie makes some of the injectables as well. So that stock is held up amazingly well. And that continues to be my top pick. And those areas continue to be my top areas to look at. In terms of AbbVie, it kind of shocked me because I was getting ready to buy it at around 154, 155. And it started the year on a gap up over 160. And it's basically been consolidating now between 160 and 165. I'm hoping to see some level of a dip back down to 155, and obviously market pressure could bring it back down there. But if it doesn't happen, then I think we're looking at somewhat of a buy around here, depending on how much you like to risk. I would not want to see it break down under 154. So that gives you a relatively decent risk at around 160, about $5, $6. And I think we could at least see 200, maybe if things got really good and the market started its footing again, up around 225. And that would be, hard to say in terms of time frame, but that would be something that I would look at more for an active position swing trade. And so that's really what I've sort of focused on right now. And of course, I'm keenly watching commodities. Sugar right now looks interesting again as it's climbed back over 22 cents a pound. That means the softs could get interesting. That could be an early sign. And of course, you can't not watch Bitcoin with all the news, but I'm not surprised to see a correction here. But at some point, I think we're going to start to see that rally again as we get closer to the halving event in April.